You're thinking about renovating your home, paying off debt, or possibly purchasing an investment property. Okay, there's money sitting in your home, but the only way you know how to access it is to crack your mortgage open and pay a penalty to do so. Okay, but I want you to think about it like this. Your house is like a keg, okay, and the money inside of it is like beer. And by the end of this video, you'll understand how to tap into it. So Sarah had owned her house for 7 years. Okay, she was looking to do renovations, a bathroom renovation that was going to cost her about $45,000. Her bank offered her a rate of 11.49% for a personal loan. And she called me and asked, is this my best option? And I said, there's money sitting in your home that you have access to. And you just need to understand what's sitting inside first. So Sarah's house was worth about $600,000. Okay, and her mortgage was $400,000. The difference between those two is $200,000. This is what we call equity, okay? And think equity being beer in the keg. And with every mortgage payment you make, a pint goes back, your equity increases, okay? The housing market increases. The value of your property increases. Well, the amount of beer in your keg increases as well. Most homeowners, they've been brewing this beer for years, but they don't know what's inside. And here's the deal, you can't use what you don't know exists. The equity is just your house's value minus what you owe. So if you want to know what your equity is, pull out your phone, figure out approximately what your house is worth. Find your latest mortgage statement, subtract the two of them. That is the equity in your home. Now, if you have multiple properties, do it for each and every one of them. And this is where people get really excited. But let me slow you down. You can't drain your keg completely. You can't take all of your equity out of your home. The bank requires you to keep 20% equity in your home at all times. That's their security. That's in your keg no matter what. And if you've ever actually had a keg, you'll understand that there's always some beer left over in the end. For your house, the only way to access this is when you sell your house. You can break the keg open and get all the equity out that you can. So let's revisit Sarah's example, okay? She owes $400,000, okay? And 20% is what the bank requires her to keep in her home. So that's an additional $120,000. Okay, so the difference between her house's worth and what she can borrow is $80,000. Okay, it's not $200,000. At the same time, it's way more than what she needs. So obviously the plan was clear. She needed to access her equity. She needed to access the beer in her keg. And there's actually two ways that you can do this. Okay, the first option is called a refinance. Think about this like purchasing a broken keg, okay? All the beer that you have in this keg needs to be drank today. You get all of the money up front. You can't say, oh, I'll take some money now and borrow the rest in the spring. The beer is going to go bad. But the benefit of this, because you're getting all of the money up front and this keg is cracked, you're going to get a lower interest rate. Okay, so for example, right now, the interest rate on a refinance is about 4%. So why is it cheaper? Well, the bank knows how much money you're going to walk out with today. Now, the other example is called a line of credit, okay? And you can think of this like a tap on your keg. The keg, it sits there waiting for you to use it. You only pay for the beer that you actually take out of the keg. But here's the thing, that beer in the keg needs to be set aside for you, waiting for you to come back. You can take 5,000 today, wait 6 months, take another 5,000, wait 5 more years and take $10,000 at that time, okay? But that beer always has to be ready for you whenever you want. The bank always has to have that beer reserved for you in the back. And so instead of paying a rate of 4%, you might pay 4.5% to 5% for that interest, but still a far cry from that 11.49% we're talking about with Sarah. And here's a common mistake that I see. Some people think, hey, I'm doing a renovation. It's going to cost me $200,000. I want to refinance my home. Here's the deal. You might only need a deposit of $5,000 or $10,000 now. And in 6 months, you'll have to pay the rest. If you refinance, you start paying on the interest today. So even if it's a cheaper interest rate, you may pay more overall interest in the long run by taking the lower rate up front. So let's go back to Sarah. She had 2 years left in her term. If she wanted to break her mortgage, it would cost $22,000. That's almost half of what the total cost of a renovation would be. Clearly, that doesn't make sense. So that is not the direction that she should go. Instead, she could access a line of credit. Instead of cracking open her mortgage, instead she could just add a tap to her keg, get a line of credit, and have access to her money without paying a penalty. Then Sarah asked me something that so many people ask me. Oh, you know what? My bank might have talked to me about this. They called it a power loan. Is that the same thing? And this is where so many people get confused. A line of credit goes by so many different names. Okay, we've got a power line, a ready line, a Manulife one, a step, a HELOC. All of these are different names for the same thing. Just like Canadian, Miller Lite, and Coors are all different names for beer, it's the same beer, maybe a slightly different formula. At the end of the day, the brew house is just putting a different logo on the tap. But here's a really important distinction. Sarah was actually offered a line of credit right off the bat. That 11.49% interest was a line of credit, but it wasn't attached to her house. So there's two different ways that a line of credit can be offered. One attached to your house and the other one not. When it's attached to your house, we call it a secured line of credit. Think about it literally attaching to your house, so securing it. Okay, this is where we have a keg. In this case, the interest rate is much less. An unsecured line of credit is not attached to anything. It's like going to a sporting event and starting a tab. If you don't pay, the bank has nothing physical that it can take away from you. Okay, so they are trusting that you're going to pay for it. And because that is larger risk, there's a higher interest rate for doing so. So Sarah ended up getting a line of credit. Her bathroom was finished. She was super happy with it. And she wanted to one day do her kitchen. She understood that there wasn't enough equity in her home. So she asked me a question. Is there a way for my line of credit to grow? And the answer depends on what kind of tap that you have. A normal line of credit, it has a fixed limit. So that $80,000 would remain the same no matter what happens with your mortgage. There's another option. It's called a readvanceable mortgage. Think of it like a self-filling keg, okay? As you pay down your mortgage, the amount of money on your line of credit actually increases. In most cases, there's no extra cost for getting a self-filling keg. This was important for Sarah. She wanted to eventually renovate her kitchen. She knew there was not enough equity at this time, but she wanted to pay down her house aggressively to get access to more money on her line of credit so she could finish her kitchen renovations. So Sarah came in thinking that she was going to get a loan at 11.49%. She left with a tap on her keg for $80,000 and a completed bathroom renovation. The only difference between Sarah and most homeowners is that she knows that the tap exists. Now, if you want a deeper dive on how interest rates are actually made, I made a video here. That's the next video. Go watch it.